And why are you so confident on this opening up of the fixed income market?
Well, China is trying to rotate its growth model away from a very, very successful export-led model that has worked for the past 25 years and taken China from sort of a Maoist backwater to the most successful export-led economy in the world. But that trade is over, if you wish. The future for Chinese exports are not as bright as they've been before because they were essentially predicated on debt-fueled demand in the Western world and the ability to keep the currency weaker in China than the rest of the world. But with the rest of the world printing money and with the debt crisis hanging over the Western world, the Chinese are rotating towards consumption-led growth. And the reason why I'm positive about China is that China has a savings rate of 50%. The room to increase consumption is enormous in China.
Yet this transition you're talking about that we see as part of this normal flow in China, some say it's not working as the government would like. The services data today really uninspiring. So what if this transition fails? Are you still confident, especially when it comes to the bond market there?
Well, I mean, here's the beautiful thing about the bond market. If the transition fails and their growth is slower than expected, they're going to ease more and bonds are going to perform even better. The transition involves interest rate liberalization, higher productivity, and opening the capital account. The opening of the capital account is by far the most interesting aspect of this because the fixed income market in China is $7.7 trillion and nobody has any exposure.
What do you make of some of the other emerging markets out there? Because I know that you think that they're a little bit in a better position now than what we're seeing with developed markets, but someone would maybe turn that around and say, well, usually when you see something happen, emerging markets are the first to gain, but they're also the first to drop as well.
Sure. Well, EM has been beaten up pretty badly for the last 4 years. If you could be God for 5 minutes, not a benign God, but maybe a Greek God, you know, the kind of gods who like to sit up on Olympus and sort of play with humanity, and you wanted to destroy EM, I suggest the following recipe. First, you start with a taper tantrum, then you drop oil prices and the commodity prices by 60%, then you throw in a 50% dollar rally, and just to twist the knife, you throw in a rate hike as well. We've just had all that. And when you look across EM, we've had no sovereigns default in respect of these shocks. We've had 2 technical defaults, one in Ukraine and Argentina, but those were very specific circumstances that had very little to do with these shocks. EM economies are much, much cheaper because their currencies are lower. They're on a cyclical upswing. And the yields that you're getting paid in EM today are higher than when the Fed had interest rates at 5 3/8%. So not only have you seen an asset class that has had an amazing amount of resilience, is now becoming cyclically very competitive, but they also pay you much more than in developed markets, and you're not buying into a bubble. So there are a whole bunch of arguments here that suggest that that's where the value lies.
A rare meeting, Facebook CEO Mark Zuckerberg sits down with China's propaganda chief to talk internet development. The company wants the tech giant to help Chinese companies build a better world in cyberspace, while emphasizing the importance of internet governance with Chinese characteristics, according to the official state news agency. Facebook has been trying to access the Chinese market, which holds the world's largest number of internet users, with about 670 million as of last year. The bottom line, Facebook is being asked to maintain peace in cyberspace.
Are you finding good investment ideas and good value in any of these names in this new economy sector in China?
Definitely, because the growth is there, as you know. Tencent, Alibaba, all these companies are growing at an incredible rate. And of course, there are a number of smaller companies that have great potential in China. One of the things that's exciting for us is that as China opens up, as we're allowed to go into the small and medium-sized companies, there are going to be wonderful opportunities.
When you look ahead to 2019?
Well, still a global cycle that is decelerating, and China is a good gauge in terms of temperature, what's going on in the global industrial cycle. It accounts single-handedly for a good chunk of global GDP growth, and the PMI numbers out today suggest that the economy is still decelerating. That's going to weigh down not just Chinese GDP growth, but really global trade. And we need to see some stabilization in Chinese demand before we really sort of can call off the warning bells when it comes to the global cycle. A recession is not yet likely globally, but with China decelerating, the numbers are going to look fairly challenging at the start of the year.
The numbers are certainly looking challenging at the start of the year, and I guess the big question is, how long will they remain challenging for? Because not only have we got some very big issues that investors have to deal with, but we've also got a lot of economists and experts out there watching what's happening globally and saying, we're in for a recession. Now that might not come next year, it might come the year after, but that's where we're headed. What's your view on that?
That's right. We don't expect a recession per se, although we have to be mindful that economists really do predict a recession, so we're a bit humble here. But broadly speaking, remember that the global economy is still growing. Monetary policy, despite the Federal Reserve hikes globally, is still fairly accommodative. There will be some extra easing steps coming through in China, helping to stabilize the cycle there. So it does look like a deceleration, synchronized deceleration across the world, but not yet stall speed. That is, it's not clear yet that we're really going to tumble into a recession. What might trigger a recession globally is an escalation of the trade war. Now, the good news is that we just heard is that China and the US are speaking, they are negotiating, they're looking to cut a deal. And if that comes through, that could really lead to a stabilization over the middle of the year in terms of expectations on investment, on trade, etc. But if we fail to get a trade deal, then that would be a material stumbling block for the global economy. And it'd be one of these things that as the global economy slows down anyways, then you get another sort of disruption that then pushes the global economy into recession. So watch the trade negotiations, probably the key development in the coming months.
Have legitimate questions, I think, about liquidity, the regulatory approach, credit ratings, default risks. Are all those questions going to be factors that really put a lid on inflows?
Not necessary, because first of all, when we're looking at the bond index inclusion, it is only right now for government bonds and policy banks. So your questions regarding the credit risk is actually less relevant till you go to the credit part of the market. So I think overall right now it's much more around access, the operational readiness, and the inclusion.
What about market structure concerns? Because one of the challenges that's been flagged are transaction costs, the cost of buying the Chinese debt. Are they manageable, or is there a risk that it could erode the return of those funds in portfolios?
No, I don't think we would see that much of a risk in the government bond and the policy banks part of it. And the bid ask is not that wide. The liquidity is okay. And as you see more of the international investors going in, you would see improvement in liquidity too. So right now, obviously, a lot of the onshore buyers, domestic buyers of the bonds, are in the buy and hold mode. So you don't get as much of transactions because there's probably not as much demand for transactions.
Okay, Mandy.
Yeah, absolutely. Naturally, China had to make a number of steps in financial reform and changes in order just to be considered for index inclusion. What more do you think will be on this path for reform? What can we look forward to on that front?
So I think overall, when we think about the index inclusion, this is a part of a longer-term journey of the internationalization of renminbi. So in terms of the reforms, I think that will continue. The more opening up of the financial sector, the reforms with regards to how you manage credit risk, more of the development of the derivatives markets onshore, all that will continue, which will actually further pave the path for both the index inclusion as well as the entry further.
From the investors, are the recent comments from China about increased regulatory scrutiny from their end, is it making it more difficult to set up global indices? You know, some are arguing China should be considered a sort of separate asset class from the U.S. and the rest of the world. Is this really an issue? Dan, are we going to see indices that are the world ex-China? And I mean, maybe you're neutral on all of that, but talk to us a little bit about that.
Yeah, look, at a high level, I mean, you know, what we want to do is make sure, again, we're not, we're basically reflecting kind of the playing field, if you will. Once policymakers and regulators around the world kind of set those guidelines, our job is to go in and then once the guidelines are set, is go into those addressable markets and being able to build benchmarks and indices that really reflect the investable markets there. So we continue, you know, to do that and really kind of engaging really with our clients where there's demand. And we can build on the standard benchmarks, but we have sophisticated clients who may want custom indices. So it's really kind of the engagement, you know, based on kind of client demand where we want to move forward.
So Tom, what Dan is saying is they're sort of neutral on this. They build indexes. You want an index some way, we'll build it this way. We're not ideological on this issue. But I'm wondering how you feel about this, because for 20 years, you and I have been talking about growing the global portfolio, making it easier to invest, believing largely in passive indexes, but also to a certain extent on some active management. And we all should have an allocation globally. It's gotten easier because of ETFs and because of indexing to do that. We've all thought, okay, so all world, ex-US, China should be 5% by market cap. So we should have indexes with 5%. If you want emerging markets, China might be 40%. I'm wondering if, given what's going on with China, what you're telling your clients, is China, first off, still investable, number one? Number two, if it is there much greater regulatory risk? And number three, is the idea of just investing by market capitalization perhaps not such a good idea, or does it not matter?
Well, so Bob, we had Brendan Ahern on last week talking about China. You know those folks over at Crane Shares, they do a great job. He pointed out that every year or so, there's a lot of saber rattling going on between the U.S. and China. There's no way that we're going to separate the capital markets of China and the U.S. They're too intertwined at this point. But
International investors had been really coming into mainland Chinese stocks, buying more than $10 billion in US dollars in monthly net inflows in December and January each. And this is really a rare amount of buying that we've seen in the stocks if you look back over the last 2 years. And it shows that some of these investment banks, their calls to buy China, some of the regulatory uncertainty seems to be waning for these investors. If you just think back to late 2020, we first had this surprise suspension of Ant's IPO back then, and then the DD IPO fallout over the summer. That has really weighed on international investor sentiment on China. But with this latest fund flow data, we see that really coming back. But keep in mind, the markets here are selling off. The sentiment is quite poor. Just have a report in from Morgan Stanley that says the A-share sentiment on the mainland shares is really deteriorated and is they advise some caution. So for the markets in the mainland, the performance is showing a bit of a divergence from what the international investment flows seem to indicate.
Well, you're not going to scare me out of China. I'm going with the big dogs. Let's go.